Rajat Rajguria joins us, Director Research, Motilal Oswal Securities. Rajat, morning. Thank you for joining us. Rajat, what do you make of Q4 earnings so far, especially for some of the index companies?
Well, we were expecting this quarter to be a very soft quarter on the earnings. Our aggregate suggests that while at the Sensex level you may see a 15% growth, that number looks inflated largely because of State Bank and ONGC. Ex-SBI, that growth rate is expected to be just 6%. And if you just track the numbers which have come till now, while Infosys started with a pretty bad quarter, at least some of the subsequent numbers, whether be it likes of HDFC Bank, Ambuja Cement, IndusInd Bank, some of them are largely okay. So they've at least helped to erase some of the losses that we saw after the Infosys result. And now as we start seeing the rest of the big wigs to report, over the next 1 week, I think the trends will become far more clear.
Rajat, is the RBI policy rate cut fully factored in by the market as of now?
Well, I think if you look at RBI's policy actions, they are definitely ahead of the street, but they are not ahead of the curve right now. A lot of their policy responses are right now reactive, where the last two CRR cuts which surprised markets was done because the liquidity was running very tight. Even now we are 1 lakh crore plus in the LAF. Similarly, the repo rate cut of 50 basis points, we were expecting it to be happen to 50 basis points because we think that some of the macro policy makers would still be underestimating the kind of slowdown severity that we are seeing. If you look at the budget presented on premise of 7.6, RBI has its own assumption of 7.3. We think that the numbers will be below 7 this year for FY13, and that itself will make the policy makers to provide some catalyst or stimulus to the system. And right now, between fiscal and monetary, the only stimulus which is left is monetary, because fiscal has to be tightened and monetary has to be eased.
Rajat, at Motilal Oswal Securities, what are your top ideas for this fiscal, which is FY13, and where are you advising your clients to put money to work?
Well, I think we will continue to see more monetary easing over the next coming quarters as the new growth numbers of sub 7% GDP gets factored into the policymakers' models. That itself will trigger some of the returns which can come in the rate sensitives. We have seen some of the specific rate sensitives like Maruti, Tata Motors, even a couple of financials like the top quality ones like HDFC Bank, etc., moving up very well. I think this rally should spread to the rest of the pack also, because of which financials continues to be a good overweight for us. We think right from names like an ICICI to an SBI to an IDFC should do well as you start getting more into the monetary easing mode. Second, cement, which has been one of the best performing sectors and seeing some headwind now on the expected news of this competition controller thing, I think will continue to do well, because companies are using their cash flows to add capacities. The cement demand growth because of robustness in mortgages and roads still remains quite good. And these are some of the very well managed companies where the cash flows will continue to be very well deployed, and ROEs of companies like Ambuja stand at 20%. We are not at the peak of the cycle. So I think cement is another sector which will continue to do well.
Rajat, and which stocks or sectors would you be underweight on?
Well, three sectors where we think we'll still get enough time before we start getting more constructive. First would be the capital goods space, because we think they would be the last in the chain to benefit once the economic upcycle starts, or the momentum from monetary easing will start getting reflected in. So that's a space where we are still underweight. Second, oil and gas is again another pack where we are underweight. Companies have got significantly diluted in oil and gas space, where they have become plays on multiple things rather than just a particular commodity, which has made some of their businesses slightly more unpredictable. And we think that if you see some correction in the oil prices, this is one space which can be an underperformer. And the third is specific consumer names. because I think they did very well because their growth stood out very well over the last 12 months versus the rest of the market. If the rest of the market growth picks up a bit, then consumer as a pack could underperform. So that's why these are the three spaces that we are being underweight right now.
Give us some mid-cap ideas where good capital appreciation can happen over, say, the next year or two.
Well, one of the issues with the mid-caps is that till the time some of these economic headwinds do not recede, mid-caps go through even more pain, because for them, right from the top line growth to operating leverage and financial leverage, everything plays against them. That's why we are very selective on mid-caps, where we still think that the franchisee values are still okay. So within this, in financials, you have several mid-caps. You have likes of you have likes of some of the PSUs and some of the privates which are doing well. You have NBFCs, where again some of the mid-caps more in the category of couple of $1 billion plus are holding out well. Then I think in cement, where again I spoke about, you have the mid-cap companies which will continue to deliver good numbers and the stock trade at very cheap valuations. And then you have some of the mid-caps in the pharma pack, whether be it company like an Ipca, Strides, they all seems to be doing fairly well in their respective businesses. And on the last, then you have specific stocks, whether it be like Syntex or some of the other infra names. They would be the one who should benefit in the first round from lower interest costs, and in the second round by a rebound in their business cycle.